Hi traders, Ryan here, and I'm hitting you with the week ahead video for the 17th of August 2025 as Blake is on dad's duties getting his son settled into his new university digs. Now last week we had some big events and data that we need to talk about and how they're going to shape things for the week ahead also, which once again is going to contain some big market moving moments. The big event is obviously the central bank's shindig at Jackson's Hole later in this week. So I'm going to talk about that and other key moments to come. And then I'm going to give you some trading setups that I'll be looking at next week. So I'm going to kick off with the key events from last week. Now, firstly, we had the RBA cutting rates by 25 basis points after surprising with a hold at the meeting prior to that one. It was a unanimous vote and Governor Bullock was far more dovish than she's been previously, with a key comment that their forecasts are dependent on more rate cuts. That was followed up later in the week with a decent jobs report showing the economy isn't suffering too much on the labour front. We did have a minuscule miss on the employment change numbers, but they were still showing a decent gain. But also we had the unemployment rate coming down as expected, so a lower unemployment rate, 4.2% there. Now, the Aussie dollar was little changed over the decision itself. It barely moved at all, but it did manage to hit a 2.5 week high on the jobs data before then pulling back on some US dollar strength that we saw Thursday over some US data. Now, moving on and regarding the US data, we had fairly hot CPI data on Tuesday. We saw the headline missing expectations was expected to go up to 2.8%, but it came in unchanged in the end at 2.7%. Now, the news was really in the core, which jumped higher than expected to 3.1%. If I can find it on the screen. Yeah, there we go, just above it. That was versus 3% expected and a 2.9% prior. So that was really 2 pips up over last month, and that really took the news on that CPI data. Then later on in the week, we got PPI data on Thursday, which showed even greater inflationary pressures there, 3.3%. That number came in much higher than the 2.5 expected, which was only going to be 1 point gain over the 2.4% previously. Pretty much all the metrics there, as you can see, the ex-food transport number there, hotter as well, 2.8%. So really hot inflation numbers that came in from the US. Then on Friday, we got retail sales. That again showing resilience for the US consumer. No real negative news from that at all. The US consumer, as the saying often goes, you don't bet against them. But we did see the Michigan numbers coming in later on, the flash Michigan numbers for August coming in a little bit softer. Headline consumer sentiment coming in at 58.6, was expected to rise to 61.9 from the prior 61.7. Now that broke a 2-month streak, a 2-month recovery in those numbers. So maybe that's just showing that we had a little bit of positivity from consumer sentiment, and maybe that was a bit of a dead cat bounce, but we'll look at that moving forward. Now, for the dollar overall, and I'm going to look at the Dixie because I know a lot of people like to look at this one just to get a gauge for what's happening in the dollar. I don't trade it. I don't believe in it. I'd rather look at things like actual dollar pairs regarding what I feel the dollar's doing. But I know some of you guys and girls like looking at this one. But overall, the dollar ranged around during the week. It was pinging from headlines to data points. And, we ended the week just above Wednesday's lows as the market saw some possible hope for some sort of partial resolution from the Trump-Putin summit on Friday. Now, that said, we do remain in a slow decline that's been pretty evident all month. So the trend at the moment is pointing for the dollar to head lower. Now, markets are still recovering from the shock of the NFP data, but the rest of the data is still showing that the economy is holding up broadly. It's still looking okay, and the Fed remains in a sticky position over when, how, or even if they should cut rates. Now, September Fed probabilities are running high still at 85%. And to show you that quickly on our new guide that we've got on our platform, as you can see there, the Fed 85% for a cut at that September meeting. Now, that brings us to the big final event of the week, and that was really that summit over in Alaska between Putin and Trump. Now, there was a fair bit of hope building throughout the week, and that hope really grew after Trump issued some positive comments after his meeting with Zelensky and EU members ahead of that summit. It was all looking good in terms of potential outcomes. Then in the meeting, which happened very late Friday, Trump and Putin spoke for just shy of 3 hours. It was after the market close, and then they took part in a joint press conference. Now, there were a lot of positive platitudes given by both sides to the historical relationship of the two countries, but really in the super nuts of it were less than encouraging. It was all a bit loose, as some things were agreed on, but other key issues couldn't be agreed on. Really, we're none the wiser about what any of those issues were, what was agreed, what wasn't agreed. And really, for all the fanfare, we're no closer to any sort of resolution than we were before this summit. Now, trying to pick some sort of minor positives out of that summit, there may be follow-up meetings between the two leaders and likely continuing talks between the respective teams. But there's really no hint as of now of any form of ceasefire yet. We now need to see how Zelensky and other Western parties review and react to that meeting and what their responses will be. Now, all said and done, if the market and risk was hopeful, a little bit hopeful going in, it may not like this result, and we could see some unwind of that hopium in markets in the Sunday night, Monday opening. I suspect most of the moves we might see might be in FX rather than any other assets, though. You know, looking at gold and how that performed this week, that sort of backs that up. We didn't really see gold moving, in any big way on the potential risk. We finished the week in gold sitting right on what's becoming a bit of a big magnet for gold at this 33.30 level. And I think you really have to take your early trading cues over what side of the level we sit at going into this new week. Now, before I move on to what's coming up next this week, I want to get my mate Nick from Trading Analytics in to give us his weekly update on stocks and indices. So over to you, Nick.
Hello everybody, my name is Nick Groves with Trading Analytics. Ryan, thank you for bringing me on today, and let's go ahead and dive into some equity coverage. So we're taking a look at the S&P right now. Here you can see that it's in an ascending channel here. Support remains at 64.44 at the moment, and man, what a week of just another rip after that fall into last Friday. I don't think that the data this week really suggests that the market should be moving higher, but the market can remain irrational longer than we can remain insolvent. I mean, look at the projection shock of the PPI just the other day. You'll notice how far extended it was as far as standard deviations, and I don't know if people were really expecting that. So you're seeing inflation hit the producers first. We'll have to see if it translates into the CPI reports, but essentially this suggests that the Fed is in between a rock and a hard place. You have weakening jobs. The revisions last month were so horrendous, and now you have inflation potentially picking up. We'll see what happens. I think Jackson Hole will be an interesting one. Another thing I wanted to point out too is that as far as an S&P 4-year cycle, you'll notice that we're actually tracking it quite well, with it typically topping out sometime in August. Will we get that scenario where we eventually pull back and then, fall into the fall, no pun intended? We'll have to see. I'm definitely trying to prepare for it, but, this market just feels so euphoric. It's difficult to, want to go against it. There's just a lot of flows. I mean, look at the allocations into equities since 2000s. You'll notice it's really picking up again. It's not a bad thing. It just shows you how relentless, the everyday investor is right now. So we'll have to see. S&P's a bit in a tug of war between the Dow and the NASDAQ. The Dow is nerve-wracking because it hasn't really made an all-time high. Sure, it's flirted around it, but I feel like it needs to get this over with and rip to the upside. Just, stop everyone out and get this over with. And you can see the NASDAQ's kind of pulling back a little bit today, but the NASDAQ is above some important trendline resistance. This started back in 2021. So until we get some form of a false breakout, maybe from a weekly standpoint, it does remain bullish. And you'll notice that the AI stocks today are actually pulling back a bit, down 2% in SMH. This is the semiconductor ETF, but there's nothing really to say other than this is still bullish, right? You'll notice Apple made a nice resurgence the last week. 786 comes in at 240. We'll have to see if that can cap it out. But the main theme that I'm noticing is that a few stocks within the Mag 7 are waking up. Apple's waking up, and Amazon woke back up as well after that pretty gnarly fall. I want to say it was down 10%. Yeah, and it's right back up in your face. So will this continue or does it tap out here? I'm not entirely sure. Taking a look at Google as well. Google just right back up near all-time highs from Tuesday, February 4th. This is another one similar to the Dow where you just kind of hope it gets it over with, right? Stops everyone out and goes higher. So as much as I would like to see that pullback and would like to see, some form of a, topping pattern up here, the truth is this all still looks pretty constructive to the upside. And if flows remain, I think that the equities can continue to flow higher, but we'll have to see. Some signs that you could look for is, taking a look at this MAGS chart. The Mag 7s account for over 30% of the S&P. If this begins to break some support at 58, 57, that'll tell you that there's a decent likelihood that a correction's underway. It's probably already underway at that rate, but a significant decline could come if we actually break here. Take a look at crypto really quick. Bitcoin, another nice tag of this monthly resistance trend line. I think it favors a pullback here. Looking at the weekly RSI as well, we have a nice 3 drive, so we'll have to see if it respects that. But it's kind of similar to how I felt about Microsoft when Microsoft was really running. Earnings were around the corner. Earnings came out well, and the stock just ripped higher even further. There is a crypto conference. We'll see how the weekend plays out, but I'm going to go ahead and pass this on back to Ryan. Thank you all so much for joining in with me, and I hope you have a great weekend. Cheers.
Right, thanks as always for that, Nick. And if you're a Trading Analytics subscriber, you can hear from Nick every day in our chat room. So come and join in there, and you'll get all his latest views and news from him. Right, on to what's coming up this week, and I've selected the most standout events, and CPI remains the important data for this week as it did last week in the US. We get Canada CPI dropping on Tuesday. Let's get up there on the calendar for you. Let me go there. Right, there we go. So Canada CPI drops on Tuesday. The market is looking for headline to be largely unchanged, maybe rising to 2% from the 1.9% previously. The core number looking to be largely unchanged. They run several core numbers there, as you can see, mean, medium, trimmed, all this sort of stuff. The Bank of Canada core number as well, 2.7%. So those numbers looking to stay largely unchanged. Now, Bank of Canada rate cut probabilities for their 17th September meeting is standing currently at 68%. So there's some room to see those change depending on how varied this data might be. Now, inflation ticked up last month, so will we see another gain this month? That could suggest that, like the US, inflation may have bottomed out in the short term and we're going to see it creeping back higher. So unless there's a really huge variation, I don't think the loonie will react that much. But as the market is always forward looking, this will be more about whether a new trend is developing in inflation, an upward trend, which will then change these expectations for future Bank of Canada rate cuts. Now, on Wednesday, it's the RBNZ's turn to get in on the act with its rate moves. We are expecting a 25 pip cut to 3%. However, as this rate will then be bang in the middle of the RBNZ's neutral band that some of the members have spoken about, 2.5% to 3.5%, the news from this meeting won't be about the cut itself, but what the conditions will need to be like for them to cut further. Now, I certainly don't expect the bank to rule out further cuts, but I think there is a good chance that their statement and comments show a bit more balance about the future and that there might be a slightly higher bar for further cuts. So I think they might move into a bit more of a neutral stance. Now, obviously, we're going to get the usual data dependency lines in terms of future moves. So that, again, could be a good indication of what is going to get them moving further on rate cuts again. Later on that day, we're going to get CPI data from the UK as well. And this is going to be another big test for the latest MPC Bank of England messaging. With the headline number expected to rise 2 pips to 3.8%, and also the core number going up a point to 3.8%, we are looking for higher inflation here. Now, the Bank of England are still in their gradual rate cutting approach. So this data is going to be very important for their next meeting. We're already pricing a near 100% chance of a hold at the September 18th meeting. Again, I'll just show you that quickly here. So we're currently at 97% for a hold at the next meeting. So this data really isn't going to change it if the numbers are soft. So there's not much room to reprice. Not much room to reprice if the numbers are hot. We're expecting unchanged at the next meeting. So the big price risk for the pound is if that data is far softer, which will open up a greater chance of a cut at the September meeting. However, we're going to need to see CPI coming in much lower than last month. So let alone whether it comes in less than what's expected, if we do see a big move less than it was last month, then that's going to get the market really shifting its rate expectations, shifting those odds, and likely we're going to see the pound moving south on the back of that as well. So for this UK data, it's not so much about how hot it comes out, because, as I say, we're pricing nearly 100% for a hold at the next meeting. Price risk is if we're going to see some softer numbers. Now, for the real big event of the week, and that's at Jackson Hole. This event can sometimes be used by central bankers to drop any sort of inter-meeting messages about monetary policy. And obviously, with Powell speaking on Friday, there's going to be a lot of market focus on this. So everything that we do next week is going to lead up to that central bank meeting and Powell speaking on Friday. Now, all that said, the main show will be Powell on Friday, and really I'll be looking for whether he needs to guide the market a certain way since the latest raft of data. Now, obviously, the NFP numbers certainly will still be playing on his mind, but as I mentioned earlier, the rest of the economy is still holding up, and we've seen inflation rising for the last few months, so he's going to need to be at his best for the balancing act. He may have to perform once again. Now, if we'd seen softer inflation number this month, I would have said that perhaps he would have been ready to nudge the market towards its expectation that a cut is coming in September. But as that hasn't happened, I'm expecting him to walk that middle path, that tightrope between easing on the jobs picture, potentially easing on the jobs picture, and holding rates steady on the hotter inflation picture. Now, what I do know is that the jobs data was only one wobble. And with other jobs reports before the Sep meeting, we've got one more NFP before the September meeting. I doubt he's going to panic and start pimping rate cuts just over the numbers that we got in the beginning of August. Now, again, expectations for the Fed, they're heavily skewed to the cut side for the September meeting. So the price risk for me is if he suggests the decision won't be as clear as that market pricing, i.e. it's not such a done deal that they're going to cut as that pricing shows. Now, in that scenario, I'd expect to see a big reaction in the dollar and yields. So make sure you stay tuned into ForexAnalytix as the week progresses, as we'll be updating on Jackson Hole when we get the news and schedule and everything else and pricing, market pricing as we go into that event. Now, this is also a great time to let you know about our trader funding program, where you can scale up your trading armory to trade the events like we've got coming up this week. Now, that's not an invitation to use a larger account to increase your risk on punting over these big events, but how you can apply your best risk management processes while using a greater pool of funds to maximize your potential profitability over such events. And I'm going to let Blake explain all that in this short video.
Are you looking to get funded as a trader? Why would you want to get funded? Well, the markets are extremely volatile. There's a lot of great opportunities, but you know, because of the volatility, you don't want to risk your own money. You'd rather risk somebody else's money. That's why traders get funded. At Trader Funding Program, we have two different options that you can choose from. One, instant funding. That means immediately you can access up to $100,000 in capital. Now, by doing that, you have risk parameters you have to follow. You can't lose more than 8% on a trailing basis. That means as you're making money, you can't lose more than 8%. You also can't lose more than 5% intraday because we want to make sure you can control your risk. That is your instant funding program option for you. But let's say you wanted to take a more economical approach. You can access up to $1 million with the one-step assessment. Now, the one-step assessment, that means that you can't risk more than 6% of your high water mark to pass your assessment. That means as you're trading a demo account, as you make money, you can't lose more than 6% with an unlimited amount of time. Once again, you can't lose more than 5% intraday because we want to make sure you can control your own risk. Now, with either option, you have the ability to keep up to 90% of the capital that you make. 90% of your returns. That's pretty awesome. You know what else is great? With either one of those options, you get included in the ForexAnalytix community for a certain period of time. The ForexAnalytix system does analysis on 30 different instruments, everything from currencies to gold to indices, and it gives you different trade ideas, analysis, live squawk feed, so you're up to date on news, you have risk management tools, everything that you would need as a trader in your toolbox to help you become successful. But more than that is you're included in the ForexAnalytix community, the private chat rooms where you have access to me and other analysts from ForexAnalytix. Imagine being able to see what I'm trading, to be able to talk to me and other analysts and other traders and see what they're doing and ask questions. Why trade alone when you don't have to? You should utilize a company like Trader Funding Program for your funding needs. So check out Trader Funding Program for more information. I'll see you soon.
Right. So now I've hopefully got you set up for this week's trading landscape. It's time to talk about some setups. Now, the first one I'm going to look at is Aussie Kiwi, which will take the RBNZ into consideration. I've been watching this one for quite some time, watching it quite regularly. Let's just get that on a wider chart onto there. So I'm looking at this pair really for a potential repeat of a big range play trade I took into the latter part of 2024 and early 2025. Now, as you can see from this chart, we're in a monster of a consolidation range that's been running for over 10 years. Pretty much in the middle of that range is the 108 level, which has been a huge magnet and pivot point throughout. Now, we have seen a fairly strong uptrend since sort of beginning of June. And that's got me eyeing some of the upper levels for a possible short build. Now, we have some decent levels at 110.20 and up towards 111.80. And I'll be watching those very closely for building a bit of a short that I might take all the way up to the top of the range, up to that 114.50, 115 area. Now, this will be a trade that will take some time and will require adding small pieces along the way, obviously while analysing whether I'm still comfortable with the trade altogether. So this is more, as I say, of a bit of a long-term trade. I've been sitting waiting on the sidelines at the moment. Now, if longer-term trading isn't a thing, I do see plenty of opportunity to play it on the shorter term too, particularly over the RBNZ. I'm just going to bring it down to a shorter time frame for you. So if they remain dovish and give a strong indication that cuts are going to continue, there's a case to see this pushing up into that 110. Now, on balance, at the moment, this pair does seem to want to go higher, irrespective of what the RBA is doing, and even more so if the RBNZ turn less hawkish. There is a chance that any dips in this pair will be bought up. So I think this pair is going to remain looking very bullish while above the 109 level. But whether we can crack into that 110 level remains to be seen. But it is a possibility if the RBNZ do remain dovish and indicate they're not yet willing to stop or pause on rate cuts. Now, next up, I want to talk about something that is vitally important if you are trading these summer markets, where we tend to see liquidity ebbing and flowing between the data points and other events. You must be watching US yields, and particularly 2 years and 10 years. Now, the reason these are important right now is because the bond market really is setting the summer tone for FX markets. Now, US 2s really reflect the market's short-term implication for Fed interest rates. Yes, it is a 2-year yield, but they do a great job of telling us where the market sees rates over the Fed's horizon, that sort of horizon they provide via their dot plots. And it is effective in watching in the short term over things like data points. Now, for 2s, we're sitting above a pretty solid zone, around 350, 364. Let me just zoom that out again a bit wider. And really how yields are reacting at that zone, after various data points and news is important for gauging how the dollar moves over those same data points. Now, we've seen times over the last couple of weeks, especially after that NFP data, where the level has held, that zone has held, and that's put a halt to any dollar selling. And it's been an important level for other data and news as well. If we get bad US data, but yields aren't willing to break that level, that's a huge indication that any dollar selling that might be happening may not last. So you need to keep an eye on 2s when watching data points and trading data points, because what they do will guide what the dollar does in the immediate minutes after the news and data. Now, the next one to look at for a bit of a wider perspective is the US 10-year yields. Again, I'm just going to zoom it in a little bit. Now, again, this is a bit of a wider guide for interest rates and the dollar. We've been stuck in a 420, 450 range for quite some time. Bang in the middle of that, we have a bit of a pivot level, 434, 435. And again, like US 2-year yields, we've been down to the bottom of that range at 420 and held it over big events. You can see that there. We've had several bounces off that level. We can't break through it. And while that happens, that's stopped the dollar selling off a number of times. You've seen dollar sell-offs, but it pauses if that level holds. Now, this yield is particularly prevalent if you're trading something like dollar yen, as both those assets have been walking pretty much in lockstep during these summer weeks. Now, that's not to say the correlation can't weaken, can't end, and it's not a one-to-one ratio for pip moves in bond prices to pip moves in dollar yen, but it's the direction and how far a move might go that's the important relationship here. Right now, 10s are sitting pretty close to that midpoint, and if they hold below throughout this week, that may suggest that rallies in the dollar might be fleeting. Now, obviously, with the big events coming up, any indications from Powell either way that he's more dovish or they're less dovish, we're going to see a reaction in yields, and obviously the dollar's going to move as well. But just as an example, let's say Powell is particularly undovish. If these yields can't break 434, 435, or even hold a break for any length of time, that's going to impact what the dollar does as well. So if Powell's undovish and you think, oh, the dollar's going to the move, if yields don't show that, that's what you've got to pay attention to. That's why watching yields this week into the summer weeks and trading is vitally important. Right, the last setup I want to speak about is gold. And I know I already showed that a moment ago, but I'm thinking this might provide an early opportunity for trading this week. Now, the reasons for staying long gold remain well in place. We're still seeing buying in China. There's still this risk situation going on. There seems no real reasons why this should sell off in any significant way. But we are going sideways, and we've been going sideways for quite some time. Now, on this early market open, if we do see the market showing some disappointing for risk after that US-Russia summit, there's a chance we see gold ticking higher. So I'll be looking closely at where we open here. If that's above, but very close to that 33.30 level, I would look at considering a tight long just to see if some risk off kicks in as European, UK markets open up properly on Monday. However, if we open below that level, I'll probably leave the trade alone and then look down lower towards the 3,300 area or down towards the 32.68.80 area, where we've seen a bit more of a range edge develop down there. So I'll really be looking to see how the market is reacting to the summit and what's going to happen moving forward. Now, on the other side, if we are rallying back up to the 34s and any sort of Ukraine resolution hasn't been completely blown out of the water, so the market is reacting negatively to the summit on Friday, but it knows that talks are still ongoing. It's not a complete dead end. If we see a rally back up to that 3400s, I'll be eyeing that move for, again, a possible range play, getting in some shorts just to see if we're going to break that area or not. Again, it's one of these levels, it's becoming one of these levels up here, 3400, 3414, 15, up towards that 3440 area. It's becoming an area where no matter what the news is, we just can't seem to get above it. So if we get a move up there early in the week, I'm going to look at that for potential shorts just to see if we can get a move back down into the range. So there's potentially something to trade here at the open, or if you want to sit and see how things play out, to look to trade the current ranges that are in play. Right, that's all for me for now. I hope you enjoyed this week's video. Obviously, if you have, please let us know. Please kindly let us know by dropping a like below, and also feel free to give us your comments about the video too, markets and trading in general. If you want us to talk about anything else, give us some suggestions in those comments as well. Don't forget to subscribe also, and that leaves me just to wish you a wonderful trading week ahead. See you on Monday.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.